Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management Practical Question 19. The following information is available in respect of security X. Equilibrium return 15%, which is the expected return, and market return 15%, 7% treasury bond trading at 140. Covariance of market return and security return is 225% and coefficient of correlation is 0.75. This coefficient of correlation is with the market return. You are required to determine the standard deviation of market return and security return. So, standard deviation of market return we can find out by using the beta formula, as we have the covariance. So beta of a return will be equal to covariance of return with market return divided by variance of the market return. Now we know the covariance, which is 225%, and since using the variance of market return we can find out the standard deviation. We can keep that as the x. Now we need to find out beta using the other information. Since we have information of market return and risk-free return also, but here the treasury bonds rate is 7%, but we need to figure out what is the risk-free return. So 7 divided by 140 into 100 will give us the risk-free return, which is nothing but 5% in our case. And substituting in CAPM model, we can arrive at the beta for the security X, as we already have the equilibrium price, which is nothing but the expected return as per CAPM. So keeping beta as 1, if we substitute in beta formula, we will get the standard deviation also as 15. We'll get the variance first, then root of the variance will give us standard deviation. Now the second requirement is determine the security return. Standard deviation of market return and standard deviation of security return. So standard deviation of market return we found out. Standard deviation of security return can be found out again using same beta formula. Now beta is equal to the standard deviation of security return multiplied by the standard deviation of market return multiplied by the correlation of x with m, then divided by the variance of market return. Now we have the in denominator and numerator this standard deviation of market return as common. So if we eliminate this, then we'll get the revised formula as standard deviation of x multiplied by correlation of x with m divided by standard deviation of m. And we have all the information here. Keeping beta as 1, and then the correlation coefficient they've given us 0.75, and the standard deviation of market return is 15. Keeping that, we can find out the standard deviation of security return, which is nothing but 20 in our case. Thank you.